Hey, welcome back to the fastest growing personal finance channel in Canada. I'm Nolan Mathias from Mortgage 360, and today I'm explaining to you the 1% 10% rule. That's the rule that allows us to quickly calculate how much an increase or decrease in interest rates is going to affect your buying power. But before we get into the explanation, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 to put towards their TFSA, their RESP, their RSP, or even if they want, their mortgage. Go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit, product, and elite price in that order. It's never been more important to get your mortgage right. Okay, so welcome back. This is all about how we do quick calculations in the mortgage world to help ascertain how quickly somebody's buying power is going to change with respect to interest rates, how we can quickly estimate how much somebody's going to qualify for, and all the little mortgage math tricks that we do that can help you quickly figure out how certain changes and adjustments are going to affect you. And really what this is all about mathematical tricks and shortcuts. Do you remember in elementary school when they taught you how to check to see if a number was divisible by 3? It's pretty simple, right? You just add up all the digits in the number, and if that number is divisible by 3, then the overall number is divisible by 3. So take, for example, 153. If you add up 1, 5, and 3, you get the number 9, and 9 is divisible by 3, so that means that 153 is divisible by 3. So it's a pretty quick shortcut, right? And there's all kinds of these. And in the mortgage world, we use a couple of different ones. The first one that we tend to use pretty typically is what used to be called factor 4. It's now called factor 5. And what we do in factor 4 or factor 5 is we simply take somebody's income and multiply it by 5, and that gives us roughly what they would qualify for. So if somebody makes $50,000 a year, multiply that by 5, and they would roughly qualify for about $250,000 in mortgage. Now, why is it factor 5 instead of factor 4 right now? It's because interest rates have gone down substantially. In the late 90s and the early 2000s, when interest rates were around 6-7%, it worked better with factor 4 than it did with factor 5. But it's just a simple number that we can use in order to really quickly calculate things and give people numbers on the fly. Now, with respect to the 1% 10% rule, well, what is that? Well, that is how we determine how much a change in interest rates is going to affect somebody. So you know how recently there was the news that the stress test was going to change, and they were basically going to change the qualifying rate from 4.79 to 5.25? Well, the way that we determined that that was about a 5% difference in how much people would qualify for is we used the 1% 10% rule. So in this case, interest rates were increasing by 0.5%, or the qualifying rate was increasing by 0.5%. So therefore, the amount that it would affect somebody's buying power would be about 5%. So really easy, really quick math. And one of the big themes in the mortgage industry right now is that people expect interest rates to go up. So what we've been teaching people is the 1% 10% rule so that they can start to budget for how much they can expect their payments to increase or their buying power to change. So in a lot of scenarios, what we can do is we can say, okay, well, if you qualify for $500,000 in mortgage today at 1.45% and interest rates go up by 1%, what that's going to mean is that when interest rates go up, your buying power is going to go down by basically 10%. So you're going to be able to qualify for only a $450,000 mortgage. It's not exact, but it's pretty close. And it's close enough that it gives us a pretty good estimate of what things are going to be. Now, I got challenged a little bit on this over the last couple of days. People were calling this arbitrary numbers, and they were getting the numbers confused. One particular gentleman said, well, why doesn't this work for $100,000 and $1 million? And the answer to that is quite simply because it's the 1% 10% rule, not the 1% 100% rule. And a $100,000 to $1 million price difference is a 900% increase in prices, not a 90% increase in prices. So you have to be really careful about how you calculate this. And what I'm going to do is I'm going to show you this today so you can see exactly what it looks like for yourself. So I'm going to log you into our online mortgage application. This is the DLC My Toolbox app, which I'll link to in the description below. You can go and download this and you can run these numbers yourself. So basically what happens is if we make some really simple changes here, it's going to adjust the numbers, and we're going to be able to see how this 1% 10% rule works by using the illustration here. So the one thing to keep in mind is the way buying power works in real estate is it's not so much about how much it's going to affect the prices. It's about how much you are going to have your payments affected. So let's say interest rates go up by 1%. That's going to change how much your payment is. And therefore, that's what's going to change your buying power. And your buying power is pretty simple. It's based on what's called a debt service ratio. So you can have a certain percentage of your income that goes towards debts and mortgages. And that percentage typically stays the same. It's typically around 40 to 45%, depending on how much money you're putting down, what lender you're going with, and what insurer you're going with. Now, as long as that payment stays the same and that ratio stays the same and your income stays the same, if we adjust the rates, what that will do is it'll adjust the payments. And what we're looking for, and what I'm talking about when we are talking about buying power, is we're looking for that payment to stay the same. So if the interest rate goes up, then the amount of mortgage you qualify for comes down, because the increasing interest rate will make the payment go higher. So we have to adjust the mortgage amount down. And that's where that 1%, 10% rule comes into place. So take, for example, in this scenario, we have two mortgages, both are at $500,000 and 1.45% interest rate. And we assume in scenario 2 that that an interest rate is going to increase to 2.45%. So a 1% increase in interest rates. So what you can see is automatically the difference in total cost went up by $72,140. Now, again, these are numbers that aren't designed to be exact. They're designed to be used as a tool. Now, what we want to do then is we want to adjust our payment or our mortgage amount down by 10%. And what you can see is once we make those changes, the total interest cost, which is that number at the top, $55,318, is about equivalent to the difference in the amount that we adjusted. So it's about 10% difference. Now, if you go and you take a look at the payments, what you'll see is that the payments end up being pretty similar. And no matter what we do here, let's say if we go up by 2%, so we go to 3.45%, and we decrease that mortgage amount by 20% instead of just 10%. So we bring it down to 400,000. Remember, this is off the original amount, which was the 500,000. And pretty much no matter what we do, those payments are going to get pretty similar. In fact, in this case, they're exactly the same. So a 2% increase in interest rates brings down the buying power by 20%. And therefore we have a $400,000 mortgage rather than a $500,000 mortgage that somebody would qualify for. So when you see things like news articles where people claim that they would like to see interest rates go up in order to cool off the housing market, the thing that you have to remember is that that interest rate increase is probably going to have a cooling effect on buying power. And ultimately what that means is that even though you're getting a smaller mortgage and you're paying a smaller nominal amount for the house, you're probably going to end up paying about the same amount for it over time, even though you feel like you paid less, but you ultimately paid a higher interest rate. Because at the end of the day, and my math's not good at the best of times, that's why we have calculators like this, but if I'm not mistaken, 400,000 plus a $99,000 difference in interest costs over time is pretty much exactly the same as paying $500,000 for the house and paying 2% less at 1.45% interest rate. So it's really simple. It's a really easy tool to use in order to figure out how much you qualify for if interest rates go up. It's also an easy tool to use if you are trying to figure out how much your payments will go up. Because if we go back here, we take a look at the exact same mortgage amount, 500,000 versus 500,000 with a 2% interest rate increase. And what you'll see is that the payments went up by just over 20%. So really easy tool, simple tool. Obviously, it's not exact math. In this case, the payments went up by about 25%, not 20%, but it gives you a pretty good baseline that you can make some assumptions off of and adjust your expectations off of. So that's the 1%, 10% rule, one of the most effective rules that we've found for quickly coming up with numbers and quickly discerning how much a difference in interest rates is going to make to somebody. And ultimately, at the end of the day, this is something that's to be used as a tool. You can always go in, get a mortgage calculator like the DLC tool, which again, I'll link in the description below. You can always go to a mortgage broker, get them to run the numbers to get exact numbers for you. But if you want to do it fast, you want to do it quick, and you want to do it dirty, this is the way to do it. So if you found this video useful, you can get even more information on our secrets to getting the lowest interest rate course. I'll link to that in the description below with a coupon code for 50% off the already discounted price. You can always join our first time homebuyers bootcamp, which I'll also link to the description below. And Ultimately, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where we're going to give away $5,000. It's free, it's easy, it's definitely worth it, and I'll see you on the next video. Cheers.